now we get to the fun prognostication part. It says they're worried that these files won't be readable for future technologies. Okay. So, got a bunch of numbers here. The IMF, or somebody said the global growth, we're going to look at global growth, should be about 2.8 this year. And maybe that was revised down. Some say 2.5, some say 2.8. Okay. How big is the global economy? US and China is 30 trillion. Right? So add the UK, add Japan, we're 50 trillion pretty quickly. Right? So we can get to 70 trillion, $80 trillion economy. So 2% growth rate on a $70, $80 trillion economy. That's a lot of opportunity. That's a lot of increase in production, right? And consumption. Someone's got to buy that, right? The only one that we look at in terms of Conference Board says US is going to decline by a little bit. Now, I think this is loaded. I think that they're looking at fourth quarter and saying, given the fourth quarter, it's kind of looking rough for 2016. If you combine the fourth quarter and the third quarter, you get a much better number. And the reason you might want to do that, and because we haven't seen the report for the fourth quarter yet, but the fourth quarter is going to be dismal. But the reason it's going to be dismal is because of inventories. So in the third quarter, we built up inventories. Why would we build up inventories in the third quarter? Get ready for the holidays. And then in the fourth quarter, we're going to buy all that stuff. We're going to buy the toys. We're going to buy clothes. We're going to buy all. And then end of the fourth quarter, we're going to decide: did we dig into our inventory? Should we rebuild more for the inventory? And we're going to get back to a normal inventory cycle. But the third quarter we built up. The fourth quarter we let it drain. And so it's going to take 0.7, 0.8% off of the GDP for the fourth quarter because we're going to not build up inventories. Okay? So if you average the two together, it kind of makes sense. We're at a slow grinding economy, which is not a difference. It's not a change for the last 5 years. It's exactly what we've had the whole time. However, Euro region is going to continue to offer QE. Japan is going to also continue to offer QE. Hopefully it actually sticks. We're already seeing some inflation numbers. That looks positive. Look at this China number. So built in is China's, they're calling it not an augmented number, but they're calling it an adjusted number. They're saying, you know what, we don't know what China really is. They have all this measuring issues. There are all these maybe inflation issues. We're going to call it 3.7. Okay? So most people that are looking at China are saying, they're already building this funny, they're already adjusting for the funny numbers. Look at Latin America. That's Brazil coming back. Okay? India, increase. Southeast Asia, Sub-Saharan Africa. Some emerging, some frontier. So there's not an expectation for there to be a big recessionary decline. They're not saying, no one is saying, which means everyone could be wrong. Everyone could be wrong. We could see a recession. It just doesn't look like it. It doesn't look like that's what the cards are saying. This is the percentage of global growth that comes from emerging versus developed. So high income is developed, developing. So there's an assumption baked in to the World Bank that developing markets are going to be a higher percentage of the growth than they were last year, which is interesting. So there's an assumption that, and maybe that's the China differential. There's an assumption that developing markets aren't going to be able to compete as well as they did the year before. The growth isn't going to come from there. It's still roughly 50-50, right? So it's not a, oh my God, what's going on? But it's an interesting note. Okay, why is that? There's a debt bubble in emerging markets. Right? We talked about that a little bit back here. In real estate and in corporate debt bubble. But let's break it down. So the red line is Chinese debt. The blue line underneath that is the rest of the emerging market debt. The green and the yellow are market capitalization of the companies there. So notice the sort of the date or the timeline. The increase in the debt it's kind of steady. It kind of increases. You can notice when the decrease happens in the capitalization. Right? It happens 5 years ago. So the company's earnings continue to increase. 2010, 2011, 2012 in the emerging markets. Companies are doing better, but the market's not recognizing it. So yes, when you compare debt to capitalization, it looks kind of ugly. But why is that? Is that because the debt is an anomaly? Or is it because we're not giving the value to the companies in the emerging markets that the market will eventually recognize? I kind of fall into the latter camp. Right now, it's the lowest relative PE ratio emerging to the United States than it's been in 20 years. The opportunity in the emerging markets is insane. Maybe it's a risk. Maybe the opportunity is there because things are going to fall apart even further. I guess that's the risk. Which is why when we build portfolios, in our most aggressive portfolio, we have like 12% in emerging markets. That's a 100% equity portfolio. Someone that's signing on to be volatile, okay? Which we have 3 clients that are that aggressive. Not many. Most people fall in the middle somewhere. So they got an 8 or 9% position in emerging markets. Okay. Slower growth, emerging markets, slower growth everywhere. More continued grinding growth. In a worst case scenario, the IMF estimates that broad turmoil, sell-offs in equities, financial assets and bonds, and spiked borrowing costs could slash around 2.5% off economic growth in rich countries through 2017. So that means in the next 2 years, we lose 1.25% per year. It still doesn't put us in recession. So in the bad scenario, according to the Wall Street Journal, in the bad scenario, yes, it can get worse. Like, we're just looking at predictions and people are saying things are bad. They're not seeing recession. Okay? So another big question is, what's the Fed going to do? And we have a lot of questions here. And we don't know the answer to any of these questions, except for maybe that one. Like, we know that the Fed is going to go really, really, really slow. There's a built into you know what the dot plot is? So the Fed, when the Fed reports, all the Fed governors sort of vote, and the combination of the vote gives us an expectation of where they're going to raise rates. And so the expectation, according to the Fed, is that they're going to raise rates 4 times. That's every other meeting in 2016. There's not a strategist I know that believes that. Everyone thinks that they're going to be, well, we're going to, very data dependent. We don't think we're going to do it. Look at what's happening in China. We're not going to raise rates this time. They're going to put it off next time, the next time. So maybe we get 1 or 2. Maybe we get 3. I doubt we're going to get 4. We don't know. I wouldn't stress it too much. They're going to be watching very carefully. They're going to do it very slowly. That's the thing. We know that this is not going to happen fast. So how are we going to deal with it? Well, dollar's going to be more expensive, especially if Europe. In the U.S. economy, is the U.S. economy ready to cope with higher rates? I think we're ready to cope with it, but it's going to affect the bottom line of corporate America. Like, so this huge profit margin, we have an incredible profit margin. It's going to affect the profit margin, for sure. How other economies react? Anyone that's pegged to the dollar is going to have a hard time exporting as the dollar goes up in value. Maybe that's already baked in. How will investors react? We're seeing it. Like, we're living through the investor reaction to an increased rate. And before that, we lived into the head fake. We every time they said, hey, rates, the market went, rates, we screamed every time. And we're screaming now. Let's wait and see. Let's see how it affects us. Will companies be hurt? So this is something to watch, is when the high yield debt group has to refinance. When the people are selling bonds into the market and they're high yield bonds, if they have to refinance, are they going to be able to do it when they have to refinance? And so probably not, maybe 6 months from now we'll look at that in a slide. Maybe a year from now, that'll be something we start thinking about. Hurt emerging markets? It already is hurting emerging markets. Is there a bottom in that? Yes. So this is interesting. This is more of an academic discussion that I don't think we have time for tonight. But what if the Fed raises rates and rates don't go up? So that's sort of a non-confident. There's the Chicago School of Economics. That's what they're worried about. They're notoriously conservative. But if it happens, what does that mean? It means the Fed doesn't actually have that much control. The market actually controls. I think that's true. The market does control. The Fed indicates what they're willing to do in terms of putting more money at risk and putting more money out there. But the market ultimately decides. So far, the market's agreed and went along. We'll see. Lots of opportunities. Divergent central bank policy places investors in a good position to scale into the inevitable price overshoots. Sounds to me like an opportunity because things are going to go in different ways in unexpected times. And so when we get a chance to rebalance, we rebalance. And that's exactly what we're talking about. These prices are going to overshoot, we're going to invest. They're going to overshoot the other way, they're not right now, but they will go back up, and when they do, we'll pull some off the table. The process doesn't change. The outcome changes based on what's going on in the world, but the process doesn't change. Terrorism can hurt growth. $52 billion cost in 2014. Lots of things there. Hurts tourism, hurts borrowing, issues there. Okay. I put this up here to look at a specific differential. So this is volume on the top, value on the bottom. So how could we trade more goods and have lower value? What is that? What's the differential? What is it that we're trading more of that's cheaper? Oil, right? So global trade, they're saying recession, there's difficulty, but if oil's cheaper and we're going to have cheaper gas, this is back to your point earlier, we're using that extra money in places that are benefits to us and therefore benefits to the economy. Like I'm not going to, if I save some money, I put it in a bank and the bank theoretically eventually lends it out. If I invest that money, I give it to a company and they're going to put it into plant and equipment. If I pay off debt, it's going to improve my future cash flow that I can do those things with, right? So if I'm saving money with that oil, that's a benefit to the economy. The cost comes immediately, and that's what we're seeing. The cost comes in Exxon and Chevron, cutting labor, capping wells, disinvesting from North Dakota, basically. Yeah, North Dakota is, right, exactly. And they can't do that forever. Yeah, they can't do that ever. It's forever. Eventually they cap or they stop it, whatever, and so supply goes down, price goes back up, right? So where are markets headed? We do this every year, and every year it's the same thing. It's either 8 or 9, but they all come up with 8, 9, 10%. But a 10% increase from here is like an 18% increase, right? That's a decent increase. What do I put in that? Nothing. I put 0. This I put something into. I mean, I think that's probably a pretty good guess, 2.5, 2.6. And I think it probably surprises on the upside. It would be interesting to me if we saw a surprise on the upside in that, a 10% increase in the S&P for the year. How would that happen? Well, the two big drags last year were oil revenues. So if you take energy out, S&P was positive, S&P earnings were positive, global earnings were much better if you remove energy. That's because oil was cratering. Oil has cratered. It doesn't crater anymore. It may go to 20. I mean, it goes to 20, I'm buying XLE. I mean, I can't, why would I not do that? I'm not going to do that in client portfolios because we already have that. We're not going to go specific to that ETF because we already have that in some of the indices or some of the portfolios that we have, right? But opportunists, Warren Buffett is going to go in and buy an oil company. I mean, that's what you'll see. In 2008, he bought Burlington Northern and bailed out Goldman Sachs because that was smart. Okay. Oh, one more thing here. So earnings growth is going to drive, so they're expecting earnings to increase, but PE ratios might contract. So just think about that for a second. Earnings are going to go up, and they're expecting prices to go up, but the PE ratios might contract. So they're expecting that. Price is going to go up less than earnings. And they're still expecting 2,200. So what does that tell you about what they expect about earnings? Expecting a pretty good pop in earnings, which it seems a little aggressive to me. But again, if you look back year after year after year, they do this. They say we expect earnings to be this, and then 3 months they draw it back and they draw it back and they draw it back. And by the end of the year, they're almost right on. Okay, good news for contrarians. An oil prospector moving to his heavenly reward was met by St. Peter with bad news. You're qualified for residence, but we're all booked. There's too many people here. As you can see, the compound reserved for oil men is packed. There's no way I can squeeze you in. The prospector thinks for a minute. He says, can I just say a couple words to the oilmen? And he goes, sure, no harm in that. So he goes in, he says, oil's discovered in hell. And all the oilmen get up, rush out the door, And St. Peter looks at the guy and says, hey, looks like there's room for you. The guy responds with, you know what? There might be some truth to that rumor. I think I'm going to go. So what am I saying here? So we know going in that there's this baseline earnings that matters and that price is really, really, really noisy. And we know, or at least it looks like all the strategists, the analysts, and everyone's saying, and our own sense is that earnings are going to go up. My sense is earnings increase. I don't have any plans to cut my own spending this year. I don't know many people that do unless they've lost a job. Even that's not happening very much right now. Okay? Employment is incredible. Wages are going up. CFOs are complaining about the fact that they've got to pay more to get good people. I mean, unemployment is 4, less than 5 now. This is not recessionary. We're averaging 200,000 new jobs a month. This is not recessionary. It doesn't feel recessionary. Okay? And yet, we're all kind of go along with what the media says. We're all sort of being panicky. The calls I'm receiving right now, literally today, are, Jonathan, should we sell? And I go, really? You need to come to the talk some. I mean, people that come sort of get it. Okay, here's one guy who says, and he had his call at Treasury bonds at 2.5, 10-year, and he reduced it to 1.5. So this is a guy saying, we don't think the Fed's going to be able to pull off what they say they're going to pull off. Okay, here's a guy that says, you know what, I'm 2.6 to 2.8. I'm keeping it. I think that's better. In fact, I'm going to raise it. I think they're going to be successful. Point here, no one knows. Okay, how do we know an economist, we'll read this piece afterwards, but how do you know an economist has a sense of humor? Someone's got to answer. I'm not going to answer until I get at least one attempt fail. Now no one's brave.
You've already drawn us into too many of these traps.
Because they use decimal points. We can't be that specific with these things. Like, we don't know. All right, we never know. Okay. Economic forecasting is an art, not a science. Of course, we have to make some guesses. The average citizen would be well advised, however, to treat all forecasts with a bucket, not just a pinch of salt. Plenty of economists tell me not to worry about sluggish world trade growth and plunging commodity prices. The world will muddle through. But they would say that, wouldn't they? Yeah. Okay, so what really matters in all this is how your portfolio reflects your plan. If you're a year away from retirement, I totally understand the panic at this point. If you're in retirement, I understand your panic. But instead of looking at, if that's the case, and you're here and you're listening and you're not going to raise your hand, but if that's the case, let's look at your portfolio. Let's look at that relative to what the markets are doing. Don't just look at the markets and say, oh my God, the S&P's down 20% from its peak in August, I should sell. Because your portfolio is not, it's not down that much. It's down, there's no question. But why? Let's talk about process and see if it's appropriate and see if we have to make a change. It's all based on your plan. Your plan will make it successful. The economy is unpredictable, no one knows. We do our absolute best to kind of manage the risk in there, but I just don't know. No one knows. Okay. And we're here to help. I want to open up for questions. I think we probably went over time. So we're nowhere near. Liar loans are not there. Everyone's got skin in the game. We're nowhere near what we were doing before. And there's all kinds of rules in place. So I remember, actually some people here might have, anyone work with Jim Aaron, the mortgage broker? Okay, so he's my mortgage broker. I've used him for 25 years. I refer him all the time. He's a great guy. I remember when I bought my condo in Emeryville in, oh my God, 1994. Bought my condo in Emeryville in 1994. I went to him, and he said, oh, we can get it appraised. I'm like, what do you mean? Well, we'll just call the appraiser. What do you mean you'll call the appraiser? Well, we'll call the appraiser and say, we need to get a loan for this much. It has to appraise for this much. And the appraiser just rubber stamped it. Yeah. Now you can't even talk to the appraiser. No. You can't even.
The mortgage company gets the appraiser for you.
Yeah, there's walls everywhere that eliminate that possibility.